This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
In the past 6 months, taken massive action, and that has not always been my MO. So I'm extremely thankful. I think this group has helped me shortcut some of those decisions and taking action. And that's really ultimately what it's about. I think that learning through taking action. And so I'm just very thankful for being able to do that and learning along the way, trying to hold on. And this group has been a big part of that. So thank you.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors. This is episode 2128. Thank you for joining me today. I have got some interesting information for you, and then we're going to get to our main segment where I am doing an interview with Dean Rogers, and that'll be coming up in just a moment. But first, this was an interesting chart I saw just yesterday in one of my newsletters, and it shows that you are getting richer. So congratulations. So here we look at the median net worth increase. Thankfully, it's an increase, inflation adjusted from the 3-year period 2019 to 2022. So this chart is interesting. It looks at the last few years of median net worth increase. It shows some different categories. It breaks them down by different categories. So heads of household between ages of 35 and 44, their net worth increased by 28%. Remember, this is inflation adjusted, which is a question you should always ask. Is it inflation adjusted? And this is, of course, it's adjusted by the official rate of inflation, which is not the real rate, but at least it is adjusted and gives us some reasonable reference. So head of household people who are older than that, 65 to 74, their net worth increased by 33%. People, interestingly, with no high school diploma. Now, you've got to remember with all of this stuff and with the next thing we're going to look at, you're coming off a different base for each of these net worth changes, right? So people with no high school diploma did extremely well, 60% increase in net worth. Folks with a college degree, only a 30% increase. But remember, those college degree folks, even though I think college is a complete scam in most cases, unless you're getting a STEM degree, they are coming off a higher base in most cases, right? They're usually doing better. So you have to compare it from a different point. White people, 31% net increase. But Black people, congratulations, same as no high school diploma, 60% increase in net worth. Hispanics, 47%. Homeowners, 34%. Renters, 43%. So the renters actually gained more than the homeowners in terms of net worth. Urban people, 36%, but rural people actually did better than urban people in terms of increase. Remember, this is all a big compared to what question, because it's compared to their prior base. 40% increase. The bottom 20%, how did they do? Well, they had a 24% increase in their net worth. The top 20%, who mostly took advantage of the Cantillon effect, they had a 39% increase in their net worth. So they did quite a bit better than the bottom 20%. But still, the bottom 20% did pretty well. Okay, the 25th to 44.9th percentile of wealth distribution. Boy, that's a mouthful. They had a 40% increase in their net worth. And the top 10th percentile of wealth distribution, a 26% increase. Now, during the pandemic time, I can tell you personally, and this is without winning that giant case I won where I got that huge judgment, because I haven't collected a penny from that yet, but just my normal business affairs. During the pandemic, I saw an almost doubling of my net worth. So, this is definitely true. When you turn on the money printer, when you drop those dollar bills from a helicopter, everybody's net worth is going to go up, but it's going to be uneven because some people are taking advantage of asset investing and asset values increase dramatically. But especially if they have long-term fixed rate debt against those assets, they're taking advantage of inflation-induced debt destruction, my trademark term that I've taught you all about for the last 20 years. And that has given them a huge, huge advantage. Now, let's look at another compared to what that's very, very important. Home equity remained near historic highs to the end of 2023. Homeowners saw an average yearly increase of more than $24,000 in equity in the last quarter of last year, just in a quarter, right? Not the whole year, just in the quarter, okay? Buoyed by a rise in home prices, U.S. homeowners with mortgages, that's important, saw their equity increase by 8.6% year over year in the fourth quarter. Homeowners saw an average increase of slightly more than $24,000 compared to Q4 a year earlier, adding up to a collective gain of $1.3 trillion, that's with a T, $1.3 trillion, according to CoreLogic's newest homeowner equity report. Net homeowner equity totaled more than $16.6 trillion at the end of 2023. Quote, rising home prices continued to fuel growing home equity, which at $298,000 per average borrower. Now, remember, those are the people with the mortgages. The people without mortgages have even more equity. That's just with mortgages. Remained near historic highs at the end of 2023. Selma Hepp, who's been on the show, by the way, just recently. A lot of you really enjoyed her interview. We've invited her back. Selma Hepp, the chief economist at CoreLogic, said in a statement. So this is really contrary to what all the doomers and all the gloomers have been saying forever, basically. And we are seeing massive increases in inequity, right? But let's look at a map. This was really interesting when you look at this map and you see the dollar amounts of increase in home equity, right? So California, my home state for most of my life, had a $49,000 increase in home equity. Well, Florida, my current home state, had a $32,000 increase in equity. But what does that really mean? Is that good or bad, or what does it mean? Well, really, it shows you that probably as a percentage, homeowners in Florida did better than they did in California because they were coming off a lower overall valuation to start with. So proportionate to the price of their home, they probably did better. The best states of all, Rhode Island and New Jersey, had a $62,000 increase in equity, and New Jersey, $55,000, Massachusetts, $53,000. So really quite amazing equity gains. Now, one possible surprise here, Texas, the great state of Texas, negative $6,000. Okay. Now, we have done a ton of business in Texas over the years, but not recently. So that is an interesting thing. And I'm not quite sure what goes into that. Texas has had a pretty big run up, and maybe they just had an adjustment. Maybe people there took equity out of their homes more than they did in other states. I really don't know. I'm not sure, but maybe I'll do a little more research on that and get back to you. Okay, now this is interesting too. This is a percentage. And like I told you in the prior slide, how California had a big increase in terms of dollar amounts, right? But in terms of percentage amount, only 0.7%. Whereas Florida, 1.1%, actually better than California. But some states did much better than that. Some states, 2.3%, 3.9%, compared to 12 months earlier, that figure dropped by 15% from 1.2 million homes or 2.1% of all mortgaged property. The national aggregate value of negative equity was approximately $323 billion at the end of the year, and that was up slightly by $9 billion. So really, to say that there is distress in the housing market is just like a nothing burger yet. It's going to change someday. There will definitely be distress someday. But right now, there's just so little distress in terms of the market. So I hope that's helpful to you. Now, if you want to know more about all of this great stuff and talk about it for 5 days, 5 nights, 6 days with us on our Empowered Investor Cruise, be sure to register for that. This is closing up. Remember, we have floating rate rooms now. So when you do register, go to jasonhartman.com, click through to the cruise website from the front page, and just know that when you register, that room price is subject to change, higher or lower. We don't know until we get with our travel agent and reserve that room for you. If you've already got your cabin reserved on the Empowered Investor Cruise, we have a Zoom meeting coming up that we're going to announce to you real soon because all of you have been asking a million questions. We want to answer them all at once. We're working on getting our cruise planner on that Zoom meeting with us so she can answer all of your questions as well. And she just does such a great job. So look for an announcement on that. Look for an email if you are registered for the cruise. You'll get an email on that. And I'll also probably announce it on the show. Also, our Zoom meeting this week is on Wednesday at 3 o'clock Eastern and 12 noon Pacific time. Look for an email from your investment counselor or reach out through jasonhartman.com for the details on this. But we are going to talk about the Northwest Indiana market. That's our highest cash flow market. You can get about 1% rent to value ratio. Yes, RV ratios still exist, hovering around the 1% range. So check this out. Our communities are about 45 minutes outside of Chicago. So these tenants really do benefit by gaming the system because they don't live in Illinois, they live in Indiana, so they get the much lower tax rate, but they get the benefits of the high wages by working in the Chicago area. So this is a really interesting market. We've been in this market for a very long time and look forward to talking to you more about it on Wednesday. Reach out through jasonhartman.com and get all the information to join that Zoom meeting on Wednesday. All right, let's get to our main portion of the show today, and that's an interview I did recently with Dean Rogers.
Hey, what's up, everybody? It's Dean Rogers. Welcome back to the Dean Rogers Show. Today, we have an incredibly special guest, Mr. Jason Hartman. What's up, Jason?
Hey, Dean. Good to see you.
Good to see you too, man. I'm super excited to have you on. You just gave a presentation recently that I just was spoon feeding myself because when there's somebody that is talking about the economy, talking about the market with real data, then I couldn't be more excited about it because there's too many people out there, the crash bros, everybody just throwing out a bunch of information that isn't backed by anything. So Jason, I'm excited to have you on. You're actually going to be doing some show and tell today, sharing your screen. So let's dive into it, man. Let's talk about the market. What you think?
All right. Sounds good. Well, thanks for having me, Dean. So there are so many misconceptions out there nowadays in terms of the economy, the real estate market. I want to peel back the onion and tell people what's really going on based on real data and based on a lot of experience that I have being in this business for many decades, more than I care to admit. We will kind of dive into that. It's just funny. First, I want to say how the human mind works. I mean, through eons of evolution, our mind was trained to look for negative things because throughout history, really until the Industrial Revolution, the negative things could kill us. Right? That could end our life either through starvation or getting attacked by another human or an animal or whatever, right? So, our mind is keenly tuned to watch out for negative things and pay attention to them, right? But now we live in this world of abundance. I mean, look at the obesity rates and we clearly have too much abundance, right? It's really a different world. And the game has changed. There's an old saying in the news media, if it bleeds, it leads. Right? And sensationalism and clickbait, that works. It works really well because of that propensity for all of us to look for negative things, right? But when it comes to the real estate market, people are creating so many blind spots for themselves and missing so many opportunities because of this bias toward negativity. There's this whole group of people that at the beginning of the COVID era, we started calling them the crash bros. Okay. These are the Chicken Little, the sky is falling people, the Malthusians, who Malthus was an economist like 250 years ago that thought overpopulation would end humanity because we'd run out of food. Well, clearly we didn't do that, right? This whole like scarcity mindset is really interesting. So the crash bros have been wrong, 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 wrong. And I think you'll see from my talk today, I think they're going to continue to be wrong for a while. They won't be wrong forever. There will always be cycles and corrections and adjustments. But so many people are equating this to the 2008 Great Recession, which was a lifetime event. That was the worst economy in 7 decades. Okay, I'd been through several cycles before that. Okay, that was a special event. Okay, it was not a normal thing. It was the worst economy we had since the Great Depression of the 1930s, which was obviously a historic event, right? So when we really look at what's going on, I think we will see there is a very different picture than is being portrayed in all the clickbait sensationalist headlines. So let's go ahead and dive in. And first, let's understand what is the business plan for governments and central banks. I always say that the two most powerful entities the human race has ever known are governments and central banks. The governments have standing armies and they work in tandem with the central banks like our Federal Reserve or the European Central Bank or the Bank of Japan or, every country that has a central bank. They control everything, okay? And our government and pretty much every other government is working with the Federal Reserve or their central bank to create an explosion of currency units. Some people call it fiat money. That's what the dollar is. And fiat, that word simply means by decree or by authority. The dollar has value because they say so, right? And we all have to believe it. And the government is very much in debt. It has overspent dramatically. It's in debt to the tune, and for those watching on video, I'll share my screen with you. This is the famous debt clock, or the infamous debt clock maybe, that many people have seen and are familiar with. And normally this is a moving thing if you visit the website, but I just took a screenshot of it here the other day. Over $32 trillion in debt. What's important though, Dean, is this one. Look down here, unfunded liabilities, $192 trillion, okay? So what does this mean? Let's compare this. What is the economic output of the entire country every year? Well, it's about $23 trillion, $24 trillion, something like that. Add these two together, you've got about $220 trillion, right? That we have to somehow pay for. You cannot pay for this by raising taxes. That's impossible. The tax revenue every year for the government's about $4 trillion. There's no way. You tax people at 100%, it would still take 11 years of everybody working just as hard as they work now and giving 100% of their money to Uncle Sam. Okay, that's not going to happen, obviously. And so this equation doesn't work. So what does work? Well, I say that the business plan of governments and central banks is the same business plan that all of us as investors should follow. We should just follow their lead and do exactly what they're doing. There's an old saying, if you can't beat them, join them. Right? And so we're going to kind of join them through this strategy that I trademarked years and years ago. I've been teaching this for 18 years. It's called inflation-induced debt destruction. And Dean, this is the hidden wealth creator with income property. Because let's take an example. Say someone listening to your show gets inspired and they decide they want to start building a portfolio. And they think, okay, I'm going to buy 4 or 5 houses. And say those 4 or 5 houses cost $1.2 million. And they get loans on those houses totaling $1 million. Okay, so they got $1 million in mortgages. They get their first mortgage statements the first month of owning the property, and it says their balance is $1 million. And then 5 years goes by. Well, let's just say 1 year goes by, or whatever time goes by, a year, 2 years, 3 years, whatever. And say there's 10% inflation that occurs during that time, which I think most people would say would happen in a year because the official inflation numbers are a lie. That's quoted by the CPI, the Consumer Price Index, and I call it the CP lie, okay, because it's clearly manipulated, right?
Yeah.
And so that 10% inflation that occurs over whatever time period basically literally just paid off $100,000 of your $1 million in mortgages because you borrow the money at today's value, but you pay it back after inflation at a cheaper value. So that's inflation-induced debt destruction. And this is the hidden wealth creator that very few people really see or understand that's going on behind the scenes with a real estate investment. And you can't really do it with anything else very well, okay? Because you can't get 30-year fixed rate debt on other assets. You can't get rental income on other assets. You can't do this by buying gold or stocks or Bitcoin or really anything else. Income property is a very unique, special asset class because it has these multidimensional characteristics. And why would this be the business plan of the government? Well, we owe about $1 trillion to China, and we have the reserve currency of the world, the US dollar, meaning that's the currency that all international trade is denominated in, the US dollar. So if we inflate the value of our dollar away by 10% as a country, that means we get a $100 billion discount on that debt every time there's 10% inflation, whether it takes place in a year or 3 years, doesn't matter. It's a discount. So this is the path the government is likely to stick with, okay? Now, inflation hurts most people. It impoverishes most people. It destroys their standard of living. I always like to say inflation destroys the value of stocks, bonds, and savings, but thankfully it also destroys the value of debt. Isn't that a beautiful thing?
If you use that leverage to your advantage and you're in the know, then yeah, that is beautiful.
Yeah, and this is that hidden wealth creator that's happening behind the scenes. But regardless of inflation-induced debt destruction, let's just take a look at the market overall, okay? So this is a chart that I shared the other day when you saw me present, and this just shows you different assets a person might have and their strength versus inflation. And basically on the bottom, the worst assets are cash, because that goes down in value with inflation. Bonds, same thing. Pension income. Taxation is not really calculated properly against inflation. And that's a long explanation, so I'm not going to go into that one today. But job income, that's sort of medium strength, because hopefully you get a cost of living increase at your job. Your rental income on your properties, hopefully you raise the rental income at the rate of inflation. And then stocks usually perform about the rate of inflation, right? So they hedge inflation pretty well. The high strength items, the gold bugs would tell you gold is the best, right? And I'm definitely not a gold bug. I own some of it, sure, but you can't rent it out. You can't finance it over 30 years. And unlike income property, it gets terrible tax treatment when income property is the most tax-favored asset class in America. And taxes are the single largest expense any of us have. In the real estate game, we love leverage because we can do more with less. If you're in the active side of the real estate business, like wholesaling or flipping, great software offers even more leverage because it solves problems like lead tracking, marketing, sales, and even operations. That's where our sponsor, RE Simply, comes in, like list stacking, driving for dollars, automated drip campaigns, cold calling dialer, complete phone system, email management, speed to lead, buyer management, task tracking, accounting, and so much more. This powerhouse software eliminates the need for juggling multiple subscriptions and different complicated integrations. So check out RE Simply if you want to streamline your investing business and start closing more deals. They made a special discount offer for my followers where you get 50% off your first month at resimply.com/Hartman. That's resimpli.com/Hartman. Plus, they're throwing in a 14-day free trial, so don't miss out. Take a look today. The mortgage. This is the hidden gem that I was just talking about, because this mortgage debt gets debased by inflation. It gets paid off by inflation. It's like free money that's happening behind the scenes. And then the value of the real estate is like gold, hedged against inflation pretty well. Usually rises faster than the rate of inflation. Okay. So that's that. I don't have time to go into the strength versus deflation at the moment, but when we look at the market, I think it's really important for people to understand why we have such low inventory. And yes, we do have very low inventory. And I don't have a chart to show you on this, but I'll just tell you. There are two major sources that we use for inventory stats in terms of how many properties are on the market throughout the country. One is the National Association of Realtors, And I don't like their data because it includes contingent sales and pending sales, properties you really actually can't buy today. And it includes listed homes that are for sale that you could buy. So I use another data set by a company called Altos that's been on my show several times, and they just count the for sale properties only. So their estimate, I think, is much more accurate. So if something's listed for sale in the MLS, it's counted. How many properties are there right now? About 465,000 listed for sale. Compared to what? How do we know what that means? Well, if I always like to liken the market to a sink. So if everybody would think for a moment of their kitchen sink. So you got your kitchen sink there, you've got the big basin, you've got a drain, and you got a faucet. The faucet represents the new properties coming onto the market, the new listings that are coming up for sale. The basin of the sink represents the existing inventory of homes for sale. Now 465,000. That's the existing inventory. The drain represents the buyers buying the properties, taking them out of the sink, taking them off the market because they're buying them, or the absorption rate. So what do we got going right now? Well, we have the faucet is on, but it's just barely trickling. Hardly any new properties are coming on the market. We've got the basin of the sink that if we consider that a normal market would be that the sink is full, and a buyer's market where it's considered a bad market or a recessionary market or a bust or a crash would be the sink is overflowing. There's way too many properties for sale.
Right.
So what do we have now? The sink is about 35% full. A lot of empty space in that sink of inventory that should be there to be at a normal market, but it's not there because we have an inventory shortage. Now the drain, interest rates almost tripled. Think about it. Think about how amazingly resilient real estate is, how strong this asset class is. Why do I say that? Because if the typical new buyer of an owner-occupied home is financing 90% of the purchase price and putting 10% down, and you take the cost of money on 90% of the value and almost triple it a year ago, and still we don't have a flood of properties on the market. We don't have an oversupply. We have the drain that is slightly plugged up because there is less demand with the higher rates. Now, normally, if that were to happen, the sink would start filling up and overflowing if the drain were plugged.
Right.
But the drain's only about 20% plugged. About 80% of it is still open and property is still being purchased, but 20% less demand, okay, approximately. I mean, it varies from market to market. That's just an overall number. And it varies from time to time, right? So that's what you've got. You've got a sink that's barely full. You've got a faucet at a trickle, and you've got a drain that's 20% plugged up with 80% open. And why is this? Why is the faucet at a trickle? Well, it's largely because of this chart. And this chart shows you that about 25% of the country has a mortgage at or below 3%. They have incredibly comfortable mortgage payments on a mortgage that cannot even come close to being replaced right now because it's so cheap. And about 65% of the country has a mortgage at or below 4%, also very, very cheap. These mortgages, Dean, have become a huge asset, not a liability, an asset, that if you sell the house, you're going to lose the asset. Let me just ask everybody listening, and you too, is it possible that some item that you possess can be worth more to you than it is to a new buyer buying it? Of course it is. You probably have some material object of sentimental value that is more valuable to you than it is to somebody else. You have your loved ones, maybe you have an animal, that's more valuable to you than it is to some stranger who doesn't care about it, right? So that's the way it is with all these houses that aren't for sale. They're much more valuable to the person that already owns them than they are to the market. If they put them on the market and they sold them, the value of that house might be worth $600,000 to the owner when you equate the cheap mortgage, and only $500,000 to the buyer who has to get an expensive mortgage. So this is the thing we're in, and this is a lock-in. All of these houses, tens of millions of them, are locked in with cheap mortgages. It's like the golden handcuffs, they use in corporate America, the golden handcuffs, right? You're not going to leave your job because they got some thing out in the future that they're going to give you, and that's the golden handcuffs. And this is exactly what's going on with the real estate market. And these people have 28 years left on these mortgages. We're going to have an inventory shortage for a long time, in my opinion. So that's the state of the market. The only real amount of inventory is coming from new builds, new construction. And guess what? Investors like inexpensive properties. That's what you specialize in. That's what I buy. We like entry-level houses because those are the best rent-to-value ratios. No builder is building those properties. Virtually non-existent almost. I mean, almost non-existent. Show me, please, somebody, where can I buy a brand new $200,000 home from a developer? It just doesn't exist. That's an entry-level home. The average new home price is $475,000.
Wow.
In this supposedly down market. I mean, it's just unbelievable, right? So we have a housing affordability problem and a housing shortage of epic proportions right now. Our deficit is like 700,000 houses missing from the market. And to just help people understand how bad these numbers really are, we got a country of 332 million people. There's about 140 million housing units, and only 465,000 of them are actually for sale. Out of 140 million, there's nothing for sale.
Just a fraction.
Yeah, just a tiny fraction. So pretty incredible, huh?
Yeah, it's pretty nuts. I mean, you said it. What's the compelling reason to sell? There's a more compelling reason to keep the house, right? And with the option of selling, right, if there's some sort of equity that was gained, if they need to live somewhere else, which they do, that next house is going to be more expensive.
Yeah.
Not only the price, but the actual cost of the money. The mortgage payment.
Yeah, you're absolutely right. You're absolutely right. So here's a business opportunity for people. If anyone is interested in getting into the home remodeling business, that's probably got a pretty good future because all of these tens of millions of people aren't going to want to sell their houses. So if they have extra money, they're going to remodel the kitchen. They're going to remodel the bathrooms. They're going to add a bedroom. They're going to put a master bedroom upstairs, right? So they're stuck unless interest rates come back down near where they were before. If that happens, then yes, they're not stuck anymore and they'll sell. But guess what? They're going to buy something else to take advantage of the cheap rates. And that increased housing affordability, which housing affordability right now is at like the lowest level in 37 years. It's terrible because the cost of money went up so much. So what does that do? That means these people, there's the choice. They got to buy or rent or be homeless. So they're going to rent. And so every 1% drop in the homeownership rate equals about 1 million more tenants that need to rent something. So if you are a buy and hold landlord investor, rents are going up, folks. They have temporarily, decelerated a bit to like the pre-pandemic levels. They're still rising, but not as much as they were before. And in the apartment market, which is suffering a lot because there was just too much inventory built and a lot of it hitting the market at the same time, rents are definitely softening in apartment complexes, but not single family homes. Okay. And I say the rents in single family homes are going up a lot more than they are today. And we'll be back with a lot more on this topic with this guest on our next episode. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.